Swayam Prabha. Digital India. Educated India.
Yogah Karmasu Kaushalam.
Hello everyone, I am Dr. Chetna Marvadi, Associate Professor, School of Commerce, Gujarat University. Today, we are going to study new method of cost accounting, which is contract costing. Let's understand the objectives of this part. In this part, we will understand contract costing, which is one of the method of costing. Contract costing is considered to be one type of job costing. There are some specific differences between job costing and contract costing, but it does not differ in principle from job costing. A contract is a term used for big jobs undertaken on behalf of customers. Such contracts involve considerable length of time and are generally undertaken outside the premises of factory. They involve constructing building, roads, bridges, a ship, etc. The system of cost accounting employed for such kind of work is known as contract costing. In contract costing, profit or loss of the respective contract is ascertained. Here, contract costing and contract account are used as synonym. In this part, 1 we will discuss about number 1 meaning of contract, number 2 contract costing, number 3 parties of contract, that is contractee and contractor, number 4 meaning of contract account, number 5 expenses of contract and their accounting treatments. Let's understand first meaning of contract. We have Special Act for Contractual Activities. The Indian Contract Act of 1872 defines the term contract under its section 2 subsection H as an agreement enforceable by law. In other words, we can say that a contract is anything that is an agreement and enforceable by the law of the land. Let's understand contract costing. Contract costing is that form of specific order costing under which each contract is treated as cost unit and costs are accumulated and ascertained separately for each contract. Let's understand parties of the contract, contractee and contractor. The person who undertakes the contract is a contractor and the person whose work is undertaken is known as contractee. The agreement between contractor and contractee contains descriptions and conditions of the work to be done, like time of its commencement, time of its completion, contract price, method of payment, penalty for late execution of contract, provision of escalation clause, etc. This agreement is known as a contract. In case of contract, the work is done on agreed price is called contract price. This price may be payable on completion of contract or in installments according to on completion of work in different stages. However, full proportion of contract price is not paid in case of uncompleted work, but certain percentage is retained by the contractee by the way of security for the due and timely performance of the whole contract. The money so retained is termed as retention money or deposit. Let's understand meaning of contract account. When contractor undertakes various contracts, he is interested in the actual working of each contract, for which a separate account is opened for each contract. In contract account, all direct and indirect expenses are recorded of that respective contract. The contract account is credited with contract price on completion of contract. The difference between two-sided of contract account represents profit or loss of the respective contract. This profit or loss is transferred from contract account to costing profit and loss account. Let's understand features of contract costing. First, each contract is treated as a cost unit. The profit or loss determination is to be done for an individual contract. It is individual unit, hence it has individual cost. Here, revenue and cost are taken into consideration for an individual work taken up by the contractor from contractee. Thus, it is treated as cost unit. Second, all costs are accumulated and ascertained for each contract. Both direct and indirect costs are part of total cost of a contract. Direct costs are direct materials, direct labor, special machine, etc. And indirect cost includes office overhead or other apportionable overheads. Third, a separate contract account. A separate contract account is prepared for each contract and is assigned a certain number by which the contract is identified. For example, a contractor has undertaken contracts of construction of 3 buildings. For recognition purpose, he may call these contracts as contract A, contract B and contract C. He may assign number to them like contract number 101, 102 and 103. He may assign number of his choice. A contractor will prepare separate contract account like contract A's account, contract B's account and contract C's account. Consequently, profit or loss of each contract is determined separately. Fourth feature is work on contracts is usually executed at the site of the contract. A contract has a special feature that where the contract of tangible thing is accepted like construction of building or road or bridge. In such a situation, work is not done in factory premises but is to be done at a place where the contractee requires that. Fifth, direct cost usually constitute a major portion of total cost of the contract. A contractor will have various contracts at different places for different customers. He may have 25 contracts and he will prepare contract account of each contract, but for his office work he will have only one office from where the operation of all these contracts are planned and controlled. These common expenses are apportioned amongst all these contracts on scientific and reasonable basis. For example, salary of site manager may be apportioned on the basis of time spent by the site manager on respective contract. For all common expenses, certain bases are applied for apportionment of indirect expenses. Next characteristics is indirect cost usually constitute a small portion of the total cost of contract. As discussed, time duration and price of contract is very high and certain contracts are to be performed outside of the factory premises. Thus, it is very obvious that direct expenses will be incurred at a site and only applicable proportioned overhead will be charged to contract. Thus, proportion of indirect cost is small of total cost. Next feature is the number of contracts undertaken by a contractor at a time is not usually very large. According to sources available, contractor would accept contracts. Once big orders are accepted, the limit of acceptance of further big orders might be restricted. It is also possible that he will not have opportunity of big orders. During recession period, to sustain, he may compel to go for small contracts. Next feature is profit or loss on completed and uncompleted contract. Some contracts may be completed in the same accounting year in which they are commenced. The profit made on such contract will be credited to profit and loss account. However, there may be some contracts which are not completed in the same accounting year. In such cases, different methods are developed for determination of profit and loss of uncompleted contract. This aspect is covered in subsequent discussion wherever it is relevant. Let us understand industries in which contract costing is applied. Contract costing is applied in number 1, industries engaged in construction of building, roads, bridges or other construction work, and number 2, industries undertaking engineering projects. Let us understand expenses of contract. The expenses incurred in respect of contract may be broadly classified in 6 parts. Number 1, materials, number 2, wages, number 3, plant and machinery, number 4, architect's fee, number 5, other direct expenses, and number 6, indirect expenses. Now, we will study all these expenses in order along with their accounting treatments. First, we will understand accounting treatment for materials. First, we will discuss about accounting treatments of material. This is very important item in case of contract. There can be different transactions pertaining to the materials. Let us understand those transactions and their accounting effect for contract account. Number 1, for materials supplied from stores to the respective contract. So, journal entry will be contract account debit to stores account. Second, journal entry for materials directly purchased for the contract. Contract account debit to bank account or suppliers account. If material is purchased on credit, suppliers account shall be credited. Third entry will be for materials returned to stores. Stores control account debit to contract account. Fourth, for material transferred from one contract to another, that is contract receiving account debit to contract giving account. 5, for material returned to suppliers, suppliers account debit to contract account. 6, for material stolen or destroyed from the contract and materials was uninsured, profit and loss account debit to contract account. It is to be debited to profit and loss account because it is abnormal loss. Number 7, for material stolen or destroyed from contract and material was insured, the entry will be bank account or insurance company account debit, profit and loss account debit to contract account. Here consider that number 1, when loss is greater than insured amount, difference shall be transferred to profit and loss account. Second, when amount is paid by the insurance company, bank account shall be debited and claim is accepted by the insurance company and amount yet is not paid by the insurance company, in this case insurance company account shall be debited. Let us understand with the help of illustration. A goods of rupees 15,000 is destroyed by fire. Number 1, pass journal entry if material is not insured. Number 2, pass journal entry if insurance company has admitted claim of rupees 12,000. Let us understand journal entry for first part. For first part, entry will be profit and loss account will be debited by rupees 15,000 and contract account will be credited by rupees 15,000. For second part, insurance company has admitted claim of rupees 12,000 and amount yet to be received. Thus, insurance company account will be debited by rupees 12,000 and the difference rupees 3,000 will be debited to profit and loss account and contract account will be credited by rupees 15,000. Next entry is for sale of materials. Bank account debit to contract account. Let us understand with the help of illustration. A material of rupees 23,000 was not of further use and was sold for rupees 21,000. If material is sold for rupees 24,500, what difference will take in accounting treatment? First, if it is sold for rupees 21,000, this is the case where there is a loss of rupees 2,000, that is 23,000 cost price less 21,000 selling price, which is equal to 2,000 loss. Rupees 21,000 will be debited to bank account and rupees 2,000 will be debited to profit and loss account and rupees 23,000 will be credited to contract account. Second, if it is sold for rupees 24,500, this is the case where there is a profit of rupees 1,500. Rupees 23,500 will be debited to bank account and contract account will be credited by the original amount of rupees 23,000 and rupees 1,500 profit will be transferred to profit and loss account. 23,000 is cost price less 24,500 our selling price, which will give us rupees 1,500 profit. Next transaction is for purchase of special materials. The entry will be contract account debit to bank or supplier account. Next, for sale of special materials, bank account debit to contract account. In case sale of special material, the determination of profit or loss on sale of special materials is not required to calculate and no entry will be passed. This profit or loss will remain part of respective contract only. Let's understand next expense of labor. This is second important cost of contract account. This direct labor cost of contract account. First entry for payment of direct labor or wages. Contract account debit to bank account. Second, for outstanding labor. Contract account debit to outstanding labor account. Let's understand the next expense of plant and machinery. This is the third important component of contract cost. Since contractor simultaneously working on diverse contract, hence recording of movement of plant from one contract to another contract, plant register is maintained. The movement of all plants are recorded here. The supply plant and machinery are of two types: supply of general plant and machinery and supply of special plant and machinery. There are diverse ways and situations for recording of accounting treatment pertaining to plant and machinery. Let's see all these different ways and situation. As stated, there are two types of plant and machinery which are used. Number one, general plant and machinery which is used on different contracts, and second, special plant and machinery which is required for respective contract only. First, we will see accounting treatment of general plant and machinery. First, charging full value of plant and machinery to contract account. Entry is contract account debit to plant and machinery account. Second, if contract is incomplete, that is work in progress, depreciation will be calculated at prescribed rate for the period for which machinery is used. Entry will be work in progress account debit to contract account. Third, if contract is completed, the depreciation will be calculated at prescribed rate for the period for which machinery is used, and entry is plant and machinery account debit to contract account. Note that plant and machinery will be debited at cost price and credited at written down value, that is after deduction of applicable depreciation in contract account. Difference of debit and credit will have debit balance, and that balance is the amount of depreciation. Second, let's understand treatment of depreciation only, that is no value of plant and machinery is debited and credited in contract account. Let's understand with illustration. X Company Limited has acquired contract for construction of a building in Gandhinagar. A machine costing rupees 5 lakh sent on a contract on 1st April 2023 and 10% depreciation is chargeable. Explain journal entries for different cases. We will understand entries. First, assume that full value of machine is debited to contract account and work is completed on 31st March 2024. When machine is sent to contract on 1st April 2023, the journal entry is contract account debit rupees 5 lakh to machine account rupees 5 lakh. At the end of the year, that is 31st March 2024, machine account debit rupees 4,50,000 to contract account rupees 4,50,000. Thus, net debit effect in contract account will be rupees 50,000. It is the amount of depreciation debited in contract account through net effect. Let us understand second part. Assume full value of machine is debited to contract account and work is not completed on 31st March 2024. When machine is sent to contract on 1st April 2023, the entry is contract account debit rupees 5 lakh to machine account rupees 5 lakh. At the end of the year, that is 31st March 2024, the entry is work in progress account debit rupees 4,50,000 to contract account rupees 4,50,000. Thus, net debit effect in contract account will be rupees 50,000. It is the amount of depreciation debited in contract account through net effect. Here, at the end of the year, work is not completed. Thus, machine account is not debited, but work in progress account is debited. Third situation, assume that full value of machine is not debited to contract and only depreciation is charged and work is completed on 31st March 2024. Here, the effect of depreciation will be given and the entry is contract account debit rupees 50,000 to depreciation to machine account rupees 50,000. Third, machine destroyed by accident and was not insured. The journal entry is profit and loss account debit to contract account. Let us understand with the help of illustration. A machine of rupees 6 lakh was sent on contract on 1st April 2023 and was destroyed by accident on 30th September 2023. Rate of depreciation is 10%. This machine was not insured. Since machine used for the 6 months from 1st April 2023 to 30th September 2023, hence first depreciation at the rate of 10% for 6 months will be calculated. Therefore, it is 6 lakh into 6 divided by 12 into 10%, that is 10 divided by 100, and the amount comes to rupees 30,000. Here, the cost price of machine is rupees 6 lakh less depreciation of rupees 30,000, which is equal to loss rupees 5 lakh 70,000. These loss will be transferred to profit and loss account because this loss is not happened due to contract activity. It is abnormal loss. According to accounting principle, this loss will be debited to profit and loss account. So, entry is profit and loss account debit rupees 5 lakh 70,000 to contract account rupees 5 lakh 70,000. Let us understand fourth entry. For machine stolen or destroyed by accident, machine was insured. Let us understand with the help of illustration. A machine of rupees 6 lakh was sent on contract on 1st April 2023 and was destroyed by accident on 30th September 2023. Rate of depreciation is 10%. This machine was insured and insurance company paid rupees 5,50,000. Let's understand this illustration. Since machine is used for 6 months from 1st April 2023 to 30th September 2023, hence first depreciation at the rate of 10% for 6 months will be calculated. Therefore, depreciation is equal to 6 lakhs into 6 divided by 12 into 10%, that is 10 divided by 100, which will give us amount of depreciation as rupees 30,000. Here cost price of machine is rupees 6 lakh less depreciation of rupees 30,000, which is equal to loss of rupees 5,70,000, and insurance company has paid rupees 5,50,000. So, here loss will be rupees 20,000 only. This loss will be transferred to profit and loss account because this loss is not happened due to contract activity. It is abnormal loss. According to accounting principle, this loss will be debited to profit and loss account. Journal entry is bank account debit rupees 5,50,000, profit and loss account debit rupees 20,000 to contract account rupees 5,70,000. Let's understand next transaction, sale of plant and machinery. On completion of work or on antiquity or on no further requirement, generally machines are sold. On sale of machine, there can be profit or loss on sale. Let's understand first situation when there is profit. The journal entry is bank account debit to machine account to profit and loss account. Let's understand with illustration. X machine of rupees 7,50,000 sent on contract of Rajkot on 1st April 2023, and due to no further requirement, it was sold on 30th June 2023 after having used for 3 months. Rate of depreciation was 12%. This machine was sold for rupees 7,45,000. This machine is used for 3 months from 1st April 2023 to 30th June 2023. So, depreciation at the rate of 12% for 3 months will be calculated. Let's calculate depreciation. Depreciation is equal to rupees 7,50,000 into 3 divided by 12 into 12%, that is 12 divided by 100, which will give us amount of rupees 22,500. Rupees 7,50,000 our cost price less depreciation rupees 22,500, which will give us rupees 7,27,500, which is written down value. If machine is sold for rupees 7,27,500, company will not have any profit or loss, but it is sold for rupees 7,45,000 less written down value, which is we have calculated 7,27,500. Therefore, profit of rupees 17,500. Journal entry is bank account debit rupees 7,45,000 to machine account rupees 7,27,500 to profit and loss account rupees 17,500. When machine was sent off the contract, rupees 7,50,000 are debited to contract account, and on sale rupees 7,27,500 are credited. So, net difference of rupees 22,500 is depreciation debited to contract account. Let's understand second situation when there is loss. Bank account debit, profit and loss account debit to machine account. Let's understand with illustration. Assume X machine is sold for rupees 7,20,000. This machine is used for 3 months from 1st April 2023 to 30th June 2023. So, depreciation at the rate of 12% for 3 months will be calculated. 7,50,000 into 3 divided by 12 into 12 divided by 100, which will give us depreciation of rupees 22,500. Rupees 7,50,000 less depreciation rupees 22,500, which is equal to rupees 7,27,500 is written down value. If machinery is sold for rupees 7,27,500, company will not have any profit or loss, but it is sold for rupees 7,20,000 less written down value rupees 7,27,500, which is giving us loss of rupees 7,500. And the journal entry is bank account debit rupees 7,20,000, profit and loss account debit rupees 7,500 to machine account 7,27,500. When machine was sent off contract, rupees 7,50,000 are debited to contract account, and on sale rupees 7,27,500 are credited. So, the net difference of rupees 22,500 is depreciation debited to contract account. Let's conclude the session. In this part 1 of contract costing, we have studied about number 1, meaning of contract, number 2, what is contract costing, number 3, parties of contract, that is contractee and contractor, number 4, meaning of contract account, number 5, expenses of contract and their accounting treatments. For completion of contract, several expenses are done by the contractor. We have covered material expenses, labor expenses and plant and machinery sent off contract. All relevant transactions pertaining to these expenses are discussed here. I hope you have understood it clearly. In part 2, we will undertake discussion about expenses like number 1, special plant sent on contract and its related accounting treatment, number 2, other direct expenses like architect's fee, subcontract, etc. Number 3, indirect expenses. Number 4, format of contract account, in that first situation when contract is completed, second situation when contract is incomplete, that is work in progress. Number 5, terminologies used in contract accounting. I hope you like this session. Thank you for listening carefully.